Welcome, everybody. This is John. I want to do a quick sound check. Hopefully, the sound level is appropriate. This is the last PUG meeting of the decade. Gosh, it's just almost frightening and shivering to even say that. Thank you, Jay. Don, hello. George, yes, very good. All right. Well, we don't have to ask if there's both rooms projecting in this meeting because this is just our monthly customer update PUG meeting. PUG stands for, again, the person's user group, and the focus is on the Algo 17 program. All right. I don't know if we asked a lot of folks to email questions in, so but I did get a question for regarding ATR once again. So I'm going to do an ATR mini class. And then if you have specific questions that you would like answered, now is the time. Start typing it into the box. It says type your message here and then hit enter. And hopefully I'm watching that, so I will be able to see for any new questions that you guys might have. All right. When you're day trading the market, so maybe I should do a quick poll, thumbs up, thumbs down. How many people are appreciating the algo program in this environment? That's an important question. How many people have come to embrace it? I mean, it's besides got a thumbs up, Jay. I mean, why don't you think about it another second, Jay? Just another second. Just another sec. Take another second to just, that came up so quick. Thank you for that. Yeah, it's in this wacky world, and when I say wacky world, I mean, folks, it is I mean, we have to use the P word, the political word, right? It is political, but the function of the economy and the media, from the financial news, is not really financial news, quite frankly, but it's kind of like just regular news. And then if you I don't know. We need to kind of. We've seen some really squirrely things this year come out of several news sources. One, of course, is now, and I think a lot of you, please don't chastise me for saying this, but Reuters Newswire service has come out, and I could be wrong here when I say 4 times, but 3 times that I know for sure. Which it's so funny because as soon as news came out, what was it, last month in November, that there wasn't going to be a China deal, and the market kind of drifted a little lower. And it's like the first question out of my mouth was, what news agency came out with that? And it was, oh, it's a Reuters news story. It's like, no, it's fake news. Because you know what? They've actually put out this year several news headlines, which creates volatility because there are people that have algorithms in the professional traders world with investment bankers and the like, people that are in control of lots of money behind their buttons they push. And if they see a headline news that may be derogatory or have a negative impact on the market, sell orders go in. And guess what? That kind of criteria is hard to combat against for the regular everyday trader. And that's been going on. That's a new kind of function. As I talk right now, many of you are probably aware that I'm under a major gun to come out with, and it's funny because I get teased for this. It's like I've been working on this second edition book for like 3 years. It seems like a decade. And there are just certain chapters that are fun to write, and there's certain chapters they just won't end. It's like, oh my God, I got to revisit all of these and update these charts. I mean, it's funny as I get into the chapter on the low and high close doji. It's like, I don't know why I try to redo anything, because it's really all the same kind of information. It's just that markets have changed. I mean, the last time I did this book, when it first was published, the S&Ps were trading at around 1230. That's 1230 handle. The Chicago Board of Trade was still the Chicago Board of Trade. Bonds, ironically, the 30-year Treasury bonds were trading at 114. Boy, I don't know if I'm going to see a 114 print anytime soon, now that we just completed another, or the last and it's fun to say this, the last FOMC meeting of the decade. So here we conclude 2019, and we've had some pretty fabulous markets and some really amazing moves. And the Algo Optimizer has helped us through a lot of these, especially in the one market that we're going to address right now, which is crude oil. So with that, take a seat. We've got this recorded. We've got your back there. We've got two different recordings going. So hopefully we have backup and you can revisit what we'll go through with you guys today. So the first thing that I look at, and I know we've done many mentoring classes on algos and follow-up educational series on the algo program. And the age-old question is, hey, John, when do we sit down and maintain or change our settings? And the one main indicator, the first thing that we got to look at is one event that's happening next week, which is rollover. So the thing about crude oil is it rolls over every month's a rollover, right? You know that about the second week of the month, you're going to have to roll out of one contract to the next one. So with crude oil, unlike it's a very unique market, but yet it still has a fairly decent ATR. Now, what is ATR? Once again, it's the 10-day average true range. And it's on this graph, I'm using a daily chart in TradeStation. And we've done this many times before. And I think one of our members in the live trading room, Brett, I don't want to throw your entire name under the table. We'll keep it a little anonymity. What book? Jay says, what book? Yeah, what book? The second one I wrote, the one with my picture on it. The one that has been copied, plagiarized, and regurgitated to death. The one that included the candlestick and pivot point trading triggers. The one that had the statistical backtest studies on what candlesticks formed. It was like groundbreaking. No one ever did this before, and we were the first to do that and show what the power of dojis were in combination with pivot point analysis. That book was produced. It was written in 05. It was published, I believe, in 06, like January of 06. So it was actually released in December of 2005. I remember signing and autographing books at November of 2005. That they released it early, but it was officially supposedly published in 2006. Any event, that book right there, Candlesticks and Pivot Point Trading Triggers. We're probably the Christmas vacation away from the entire Christmas vacation away from having it the first complete manuscript. It's been in the process of updating for 3 years. I'm going to have to update the first few chapters that I wrote 3 years ago. That's how bad this is. So Jay, that's the one. The mystery one, that is not out. This is the second edition of Candlestick and Pivot Point Trading Triggers. I really don't. It's a struggle to write between trading, launching J-Person Asset Management, running the algo, and trading on a day-to-day basis in this crazy environment we have. And so, back to what we were focusing on. Average true range is a concept that was introduced to us by a man by the name of Wells Wilder. And without getting into too much ado, most of you already know what ATR is. I'm not going to go bore you with those details. In fact, many of you are familiar with how we utilize the ATR. So I'm going to make this kind of quick. The average true range I use is a 10-day period. That gets me on a daily basis about half the month, right? Because it's a little bit, the longer time frame you use, the less sensitive it is to market changes. Now, what I was saying in terms of commodity markets, if you're trading an algo program, if you're trading something that consistently gets you in and out, we need to have a couple ideas. Liquidity, that's one idea that would work, right? We need to have access to the market. So commodities allows you that 24-hour access. That's number two. And number three, you have to have the dynamics of the market that moves. Right now, there's one market that I could say is really just dead to the world, and it's foreign currency the euro currency, right? The euro currency has been in a it is in a historic low trading range environment since its inception. That's a scary thought, right? Because people were so programmed that they could make money in trading Forex, and you can only make money in markets that move. If you get in and you can't get out and nothing happens and you're sitting there staring and waiting, and you pay the VIG or pay through a bid and ask program, you're going to pay a couple extra ticks to get into a trade, a couple extra ticks to get out of the trade, and if a trade doesn't move, you're going to lose money. So we need a little bit of volatility, but we also have to address changes in the way a market trades. And that's one of the things about crude oil, and why everyone that got the algo program, we set everyone up with several workspaces. I believe crude oil was one, Apple was another, Bitcoin, which was popular when we first did it, the GBTC. But crude oil delivers to us more times than not in a market environment that trades during the day. And so we went through a period this year over the summer from about May, as you can see right here. We went through this period in May, late April, early May, and then all of a sudden, as the ATR started to expand into this time period, we changed our settings. We had a setting in the market that was used to trading in a very lower or declining ATR environment. And so when we expanded into that ATR environment, we changed the settings in our live trading room. And as you can see, I mean, the market was up, it was down, it was down, it was up, it was down, it was up. And this gap right here, which is so amazing and how unique the market is, that gap was a Sunday night move in crude oil from the Saudi Arabia refinery terrorist attack. And I know everyone remembers that. 2019, a year in review, this was crazy. But through all of that volatility, up, down, sideways, our algo program made money because of one simple reason. We identified there was an expansion in ATR and said, hey, what we need to do is change the settings and modify and maintain the strategy to adjust for not up or down, but for increase in ranges. And so a scale in approach, or excuse me, a scale out approach optimized a little bit better. And so when you go through a period, and one of the things I'll tell everyone, never scrap an old model. I'm not to say that if you have a model that's in a period of a heightened ATR period, you'll see this was just a heightened ATR period right here, meaning we were around $2 or so. I mean, if you think about it, if you're around $2 in an ATR, but the market only does one thing, it just goes straight down. That was a defined trend in the market. Well, obviously, if you had the insights that the market is in a trend mode, turn off long only and develop a short only model, right? So that's number one. ATR expansion generally does not dictate a market direction. Now, this is listen to this very carefully. We covered this in our trading seminar. Here's an expansion of ATR, right? This is an expansion in ATR back in, what was that, November of 2018. The ATR went up from that time period. Market went down. So average true range is not an indicator that dictates potential trend moves. It just tells you that there's heightened periods of volatility in each bar. And generally, the rule of the thumb is that average true range, especially using a shorter term model like a 10-day, they tend to break trend and trade for a while in that direction until the trend is broken, and then they tend to go into a trend of declining, and then the trend is broken. So as you can see, crude oil has a habit of, when it breaks in an ATR environment, it tends to trend in a higher ATR environment for a while. Now, something happened here in October, and what we've done is we've contracted in our average true range. So we went through a heightened period. Think about this. from on or about the end of April, the 1st of May, until on or about the 1st of October, we were in a heightened period of volatility, and that's where we made a lot of really exciting money on our algo system. And then all of a sudden, something changed. It was almost a time bomb went off in the volatility, and then the rest is history. We've just kind of gone in a very mild, choppy upside market movement, and that's why in the live trading room we changed our algos to modify a contracted ATR environment. Now, let me be more specific about ATR. So this is about ATR and how you use that tool to help define building day trade models systems, okay? So even swing trading systems in a higher time frame, 60-minute or daily end of day trade system, if you have a higher ATR environment, your holding period and your profitability and your risk all expand. That's the nature. In a lower ATR environment, your intraday trends may be muted. And so therefore, it doesn't make sense in a low ATR environment to scale out. It's almost as if you have to get out of everything all at once. The last point I want to make about average true range is this. As far as most markets are concerned, average true range, and I want to reemphasize, is not an indicator that denotes a trend. It's an indicator that denotes condition of the market, increased volatility, with one exception. And that exception is, typically speaking, stocks, equities, the stock market. The average true range, and I think this is more indicative of the utmost in fear and greed environment. But you will notice, as I shared with you with crude oil, and I want to share this again, that when you get a period of increased volatility in crude oil, it did not indicate the market going up. It did not indicate the market. It just simply, as we went through this summer, volatility went up, the market went down, the market went sideways. It was just more market participation, more wild ranges. But in the case of equities, stocks, the S&P 500, if you take a look at that ATR I just colored in, and you take a gander at the market right there at that same time period, it's more indicative of market declines. Higher ATRs is indicative of market declines. So when the ATR contracts, it's more indicative of market rallies, because in stocks, markets go down a lot further, farther, faster than markets tend to rise. So when you see a period of decreasing ATR in S&Ps, it's generally a sign that the market is in a bullish trend mode. So it's the only market. You could back test this yourself visually. You could back test this if your name is Brett. And Sherry says, should I have audio? And the answer is yes. And so the answer is yes, audio works. And log out, log in, or refresh. Log out, back in, or hit refresh button. I hope I didn't make a typo. I'm in there. It is. Yes, audio works, and you could just hit that little, circle wheel. All right. Thank you, Sherry. I hope it works for you. All right, so that's the point I wanted to make with ATR in the market. The other day, I had actually in the live trading room, many of you remember, I said, interesting, we were at a low ATR environment from this last part of October. We were falling, and we were in a low period of ATR. And I said, just recently, over the last couple of days, we went from a sub 20 ATR. I think we hit like 18 and change on a 10-day basis. As you can see, it's below 20 right there. And over the period of 3-4 days, we expanded the ATR. What a coincidence. The market went down. The market is it done correcting? Let me ask you this. Is the ATR trending up, down, sideways? Has it removed or negated this latest increase in volatility? If you notice that we have not negated this last bit of increase in volatility. So the market, in my humble opinion, by just that one simple tool, tells me that the market is still vulnerable and capable of maybe this for a couple until we see a change in that trend direction of ATR. So just as a word of caution, that's about the only, and I repeat, the only time that I use ATR to help identify a market trend condition or probability of a reversal for equities only in ATR. Okay, so that's where I stand with average true range. That's in the terms of Forrest Gump, and that's all I have to say about that. Okay, does anyone have any questions on what we covered so far in the average true range tool? If there is no question, for TradeStation, if you just simply right click is the word I'm trying to say. If you right click and go to insert analysis technique, and the magic wheel is circling, it's thinking, and then all of a sudden it's alphabetical, so go up to average true range, and you will see average true range. When you open up average true range, you'll see it'll input average true range. It defaults, if you notice here on your bottom of the lower left quadrant of the chart, you see average true range 14, 14. If you just simply right click again, format analysis technique. All right, and go to average true range. And so I've got it on twice, so let's just remove one. And let's go to format this. And if you format, go to input. It defaults to 14. Why? Simple reason. When Wells Wilder created the concept of average true range, it was designed to account for gaps in the market. And back in the late 70s, he was a commodity trader. He was not a stock trader. He was a commodity trader. And the markets would gap often under conditions known as limit moves. If there was a supply-demand imbalance and everyone wanted to buy soybeans, the maximum upside the market could move would be 30-cent value up from the prior close or down 30 cents from the prior day's close. So the market went, quote unquote, limit up. It opened 30 cents higher and it traded 30 cents higher, and it can't trade any higher than 30 cents higher. It can trade lower, but not higher. And if it opened limit up and it never traded because there were no sellers, then guess what? It closed limit up. What is an open close relationship with no range? Well, there's no range. So what is the range? 0. No, the range was 30. 30 cents was assigned. So it's the greatest of the two differences of the high low of the day, or the difference between the market's previous day close and the current bar's close. Whatever the greatest is, that's assigned the quote unquote range. So he used 14 as a half a cycle, like a moon cycle, 28 trading days or 28 days to the month or 28, whatever he was thinking. Okay, so that was his quote unquote half cycle. That's how it was written. That's how the indicator was created. Any platform would pick up a trading book and say, Wells Wilder's got 14. We're going to do what he said. It's his indicator. Well, what did not happen back in 1970 is that we didn't have 24-hour access to the markets. So therefore, 14, it's half a cycle. But in reality, what is half a cycle, half a month? 10 trading days now, right? So I personally logically do not use 14. I use 10. And if you just go over and for whatever reason, I change just to have both of them, ATR length and alert length, and just hit OK. And guess what? Now you will see you have a 10-day average true range, which is synonymous with a daily chart of what? 10 days. All right. Now that's important. That ATR concept is important. And I'm going to jump ahead here. And we're going to jump ahead and I'm going to format strategy. So the model that you see here is a model that does not scale out. It simply gets all in, it gets all out at a predetermined target. And so when you optimize your own program, you will optimize a strategy that has to adapt for periods of low ATR, and you're going to have to adapt a strategy for higher ATR. If we have a market event, so for today, for example, let's go over and look together. We'll go to commodities and we will go to the January futures contract, which we're going to be rolling out of January into February. It sounds so weird. It's Christmas isn't here, and it's already, we're going to be trading crude oil. That's going to be the month of Valentine's Day. So then we have CLH2O, and you can just change your settings there, and you can go down and look at the forward contract months of the crude oil. And so you will see where your major volume is trading. We're still in January, but again, it's not the middle of the month. But as we get closer to the middle of the month, you're going to start to see the rollover volume go from all January then into February. All right. So look at the range today was in crude oil $1.11. The 10-day average, if you take yesterday, today, the day before, day before, day before, day before, and divide by 10, there you get $1.63. So today we had a sub ATR day, and it's going to rack that number a little bit lower for tomorrow. So the moral of the story is we got to be aware of what the current environment is relative to the average true range. And on TradeStation, if you right click on your radar screen and you go to format average true range, you should make it 10. Now you can also look at 20. I wrote about that in one of my books 20 years ago. But I like to look at the 10-day is my go-to number, my 10-day. All right. In the equity markets, ES, today we had an expansion of ATR, which we were under a little corrective phase. We had Fed talk today, and this morning when we walked into the live trading room today, we were at 14 points. I said there's a chance, since we are 14 handles, that with the Fed, I would imagine we could see an expansion of ATR. And guess what? I was right. We did. It expanded from 14 to 15. I mean, that was a joke. So this is this was a very muted event by all historic measures of a Federal Reserve meeting. So all eyes do not really care much about the Federal Reserve. They're relieved, but it's all about, my guess, China and future effects of continuing to stimulate the not just domestic but global economy. But anyway, I digress. That's for another day. The focus today is on how and why is it important to pay attention to ATRs. Because if you think that the market is going to, one day it's going to expand, okay, one day does not make or break your career. But if we get into a period of expansion of ATR, and I always like to look at least a 3-day event of expansion in ATR, at least 3 days of expansion in ATR, or at least 3 days of contraction in ATR before I start scratching my head saying, hey, I need to change things. Because if we go through a period of expansion in ATR and crude oil and we get back into like $2, if we get back into $1.80, we get to $2.60. The model that I have right now that gets me out of both contracts with a small profit, well, that's okay. It's a small profit. I mean, this, today in the live trading room, we did have a trade that took that short before the report came out. We got to probably address that unit. But the moral of the story is, ladies and gentlemen, is that in a smaller ATR, you don't have a chance to scale and trail a stop. It's like the market has a trend, it hits, it's done. It's a small range environment. So small range environments you're more apt to have better success in a strategy that gets you all out of your trades rather than out of half and trail a stop. Now, when you go back and you say, well, John, I did a back test study for 1 year, and I see in 1 year we had a period of trend and upside downside, but you also had a period in that year, and your optimization is only taking the best performance of your strategy in all of that volatility. But I would bet your drawdown in you missed out on some really tremendous profits when you went through from August through October, that period of heightened volatility that we had. And so when I say that no one should scrap, or in fact, from May or June all the way to October, we were in a heightened period, an elevated period of volatility. So never scrap old models. Always print out your settings, write notes. This was good in an ATR environment, then take notes. Journal. This is another way of journaling your trading and journaling your strategies. This strategy worked when crude oil was stuck in a range between 52 and 55, and the ATR was $2.20 on average. Boom. Now we have crude oil near $60, and we have a lower ATR environment. So if the ATR remains to the downside, you're going to want to modify. And what was the first thing that you're going to modify? You probably need to modify your scale outs. The second thing you're going to have to modify is potentially your risk and rewards. So let me go over and also identify something here that we want to share with you. And ATR, that's the focus of today's PUG meeting. We created this concept of the compression exits. Now this model, and again, I want to make sure that I cover this a little bit. And that is, we have we added not one, not two, but three various trailing stop models. Which one's best? Well, it depends. It depends on the market condition. And one overrides the other. In a higher ATR environment, we had this summer, and I know many of you were there, and I know we had a lot of things, but we had a compression exit ATR, I think, in the crude oil of about 8.75, I think. It was close to 9, I believe, right? What does that mean? ATRs to start. The compression exit, and this one only uses, by the way, the dynamic exit. What is dynamic exit anyway? The dynamic exit is a function of ATR as well as last conditional change. And as the ATR and the last conditional change, as you'll see the gray lines right there, the function does not use ATR, last conditional change. It uses the average between the last conditional change, which was that pink one right here, and the ATR, which is the gray lines right there. So this buy signal didn't quite get to the profit, as you can see, and it stopped out on the dynamic exit. So what is this compression exit? And when you use it, whether you use it and it says yes or no, and I'm going to just optimize this right now and say, should we use the compression exit? Start yes, no. So no is 0, yes is 1, jump rate, it's between yes and no, which is 0 and 1. Now, maybe I should, in a low ATR environment, start with what? Something below 1, so 0.5. And just for the heck of it, we're only going to use 5 because we don't have enough time. I don't want to get too heavy in an optimization class right now. But what is this asking me? Is this asking me, it's telling you, what you're asking this is, should I use a compression exit, which means as the market goes up over time, I want my stops to compress, and I want it to start kicking in once a certain ATR takes over. It's not the ATR of the day, it's the ATR of the time frame in which you're programming. This is a 5-minute bar. Look at all of these 5-minute ranges. If you have a 5-minute range of, say, 6 cents, 2 ATRs is what? 2 times 6 is 12. 12 cents. 3 ATRs. The stop will not kick in until 2.75 of your ATR. So anyway, let's just go and we'll optimize this. So again, ATR has a function in the algo program, A, to help us to understand when we should modify our holding scale out periods. It should also help you to identify what kind of stop method to use. So Chris, I'm going to get to your question. I like your question, and I got a great answer for that. So here we just redid the same thing just happened, and let's see what the format strategies came out with. So in this case, the ATR says, you know what? Keep the dynamic, the compression. Yeah, let's pump that up, and the profitability is better in this lower ATR environment. Now with the using of the compression exit and 2 ATRs. Now I'm wondering if you think about this, for example, if it takes a long time for the market to reach a specific profit target. Now this is an unusual. This was a report that came out, and it could have gone either way. But needless to say, by modifying your exit, if it is a narrow or smaller ATR environment, it may take longer for the market to get near your profit target, or your profit targets might not be achieved at all. So the longer it takes in a narrower range for the market momentum to move to give you a profit, you would want your compression exits optimized. I'm going to repeat what I just said. In a small range or declining ATR environment, it will take longer. Your holding period will have to expand because it may take longer and a longer time frame for the market to churn to provide and maybe achieve its profit target. In a wild west higher ATR environment, wild ranges, it may take 1 bar or the same bar or 2 bars to achieve the same type of profit, and therefore your holding period might be a lot shorter. So higher ATR environments, they come with bigger risk. I said that at the beginning of our presentation. The higher ATRs have shorter time frame holding periods, and your position size may have to be adjusted. In lower ATR environments, and this is where a lot of traders get into a lot of trouble early in their trading careers. They get into a very boring market, a very narrow trading range market, and they go, gee, in order for me to make $1,000, I got to trade 20 lots. And the one day they get into a 20 lots, the one day the Dow has 1,000-point decline on them, and they're like, well, what do I do now, right? So that may be a little bit of being a drama queen, but I'm just saying that this is the kind of a tool that we have to know about our trading environment, especially for day trading. Okay, so with that said, what is the actual? I mean, this max trading bar says 16 bars on a 5-minute basis. Well, I'll re-optimize that. So if you think about, at least 6 bars up to 30 bars on a 5-minute basis is how much time? I mean, 12 5-minute bars is an hour. 24 is 2 hours. If it takes 2 hours for a trend to develop, anything more than 30 hours, you've probably overextended your length of stay in that day trade trend mode, right? So I'll just optimize this for you right now to give you an idea of what is the priorities when we start to get a lower or a change of ATR. So first thing you want to do is you're going to obviously say, should I be scaling out in a market? Should I change my compression? And what's my holding period? So let's double check the format, the strategy once again. Go to format. And you will see that we had 16, and you know what? Nothing really changed. it went to 15. So it just changed by 1 day. That's really not that big of a deal. So with ATR changes, you got to remember the first thing that you want to do is if we get into wild ATRs, it may behoove us to do what? In a higher ATR, change your whether your scale out function is set at 0, 1, or half, right? In a lower ATR environment, you're more apt to find better profitability by getting out of everything rather than trailing, because once a market has achieved its move, that's it. You're done in a small ATR environment, okay? The question here right now is from Chris, who says, John, I know that you mentioned that only specific SPY and increasing ATR indicates a higher probability of a down move. How does it relate to a single stock? How do you measure if an ATR would be considered low for a stock? So it's a trick question, Chris, because unlike the overall index, which is a dynamic function of variable flows, economics, interest rates, and a single stock has maybe less influences and probably doesn't move consistently over time. An earnings event 4 times a year, perhaps an industry shakeup that might affect the market, right? A competitor says that the whole industry is doing bad, and therefore your stock one day would be subjected. So it doesn't have enough. Stocks, in essence, do not have enough consistency for an ATR to use for intraday trading, in my humble opinion, based on that logic process. Okay, so we did, I believe, a model on Apple. Let me see if I can find it. POA. It was an older workspace. There was the one that we did with Bitcoin, and I'm not even sure if I even have that on this particular computer. But here, Apple. I believe many of you, we provided a trade strategy on Apple. And with Apple, if we take a look at and I'll right click here, and let's just do this. Insert analysis technique. And let's insert average true range. I mean, everyone likes to trade. I mean, Apple has a range. I mean, Apple can provide daily ranges that you can, at least maybe there's people that like to day trade stocks, and they have a list of their, favorite day trade of stocks. Now, again, if we go over here to your advanced trading system and you go over to your stocks longer term and you have your average true range, you can double click and it'll collate. Double click, I mean, and it'll collate. And, one of the biggest, baddest boys on the block, of course, is Amazon. It has if I'm not mistaken, double check format. I always like to do this. It's like check and double check. Okay, so I didn't alter anything in the middle of our presentation. It's still ATR. So the 10-day ATR on Amazon is $24. So consistently in the last 10 days, $24 is my expected movement it does on average, right? So some days will be better than others. We get that. But on average, I can expect that market to move $24. So if you're looking for a good market to day trade, first off, what is the percent of that $24 represent to its value? So you have that under consideration. Is there enough volume for you to get off any trades? Well, if you can do 1,000 shares on Amazon every day, God bless you. You have some money in your pocket, right? But there's plenty of volume, that you can pop off a day trade in Amazon. What do you want to do with average true range? You want to identify what is the product doing currently in relationship to the ATR, and then the second thing is there volume? I know that there is volume in the commodity markets consistently, so I don't have to fact check that in crude oil or day trading E-mini S&P. So it eliminates me to search for high volume stocks and compared to stocks that have movements in its average true range. So that's for one. So I'm looking for something that has a decent average true range that I can day trade in. And so when you ask about Apple, and without having to go very far, we've got Apple in a watch list already. So you have on average a $4 move on Apple. And today everything across the board was almost less than its normal average true range, except for one little feller over here, Tesla. Okay, so I just wanted that to be how can you develop a model for day trading a stock, right? So a stock is a little bit different from day trading purposes versus developing a system, a holding system that goes long and short. So I mean, the average true range, I mean, here the ATR went up and the stock goes up. Okay, so average true range went down and the stock went up. So ATR is not a function in identifying whether or not the stock's going up or down. ATR goes up and down whether in conditions of Apple going up and down itself. So that's kind of a here ATR. Is this a from this point here, Chris? Just as a case and a reference point. So let's compare an apple to an apple, and let me get the right color. Okay, so from this point in time until that point in time, the stock went down. If this was the equities, the ATR would have gone up. In this case, the average true range went down, right? So that's so how does that help you with ATR and Apple going down in price and the ATR went down in price? This looks like someone having a cardiac arrest on an EKG machine. And this is not just this year. You can see that we've gone back all of 2019 and most of 2018. And you can squinch up your data. So by developing a trade, Apple is not trending. I mean, it looks like it trends consistently, right? But as you can see, it's had periods of dull and boring downside action, then it barely breaks out, and then it crashes, and then it's done nothing. And so buy and hold over that period of time hasn't really, I mean, the stock went, of course, from 50 to 270, and that's since 2013. A trading model has provided, and what you see down below is the equity curve for this particular model. So in any event, the ATR, as you can see, the higher the price the stock has gone, the more volatile the environment is. But ATR has not been reflective of a trend for Apple or that particular stock. Since we have this all lined up, now I'm going to change this symbol. It's got nothing to do with the strategy. The equity curve will probably change because it's not been optimized. But let's look at AMZN. I only am focusing on the average true range, okay? Not the performance, because you can't take a trading system of one stock and just apply it to another just for the heck of it. So the average true range, ironically, is been in this stock as the price is, I don't know, what do you want to call that? 400% greater. The stock was at 400. No, it was 200. I don't know what you want to call the stock, right? So here is the stock trading at around $200 in 2013. The stock's at 1,700 now, and ironically, the average true range is trading just slightly elevated above where it was when the price was, I don't know, 8 times cheaper. So average true range is not a function of the directional environment of as a directional tool indicator. It's a function of volatility and your environment in which the market is trading. And that's why average true range, it's one that a lot of people don't like to talk about, because people think, oh, what use is it to me? It doesn't tell me whether the market's going up, down, or sideways. But average true range is a function of holding period. Average true range is a function of position sizing. And by the way, isn't scaling out of half a position considered position sizing? Because you're getting out of half, right? And letting the trend ride. That's position sizing in a definition of average true range. So if you have a narrow ATR environment, why am I holding the whole thing? If I got my profit target, I probably shouldn't be trailing a stop. I probably should be getting out of the trade. In a market that expands its ATR, take something off the table and trail a stop, because the market may trend to ungodly levels for the rest of the day. If you're in a $3 crude oil ATR environment and I have a $700-800 profit on one position and I'm doing 2 lots, then by all means scale the trade for the rest of the balance. I might get lucky and get a $2-3 move today. And that's what we were doing back this summer in that market. Okay? So I think that the function of the PUG group today was, again, the subject matter was, how does ATRs work? How do you use ATR? And more importantly, what does ATR got to do with anything that we've programmed with our models? And so with the Algo 17, obviously ATR has been built in as an important function in developing a trading strategy. You're allowed to optimize whether or not, and let's just go back to this crude oil and let's just see where we're at and see what changed, what would have changed today. Should we get out of some, none, or half, or trail the stop? Now, I'm not going for a major building of a strategy in front of you. This is a demonstration purpose only to say what would have happened. Did things change in this environment? And the answer is no, it really didn't change anything, right? So what did it do? Format the strategy. I believe it looks like it changed the exit on the dynamic over here, relative. And as you can see, scale out ratio. No, it got out of everything. So it never changed. Now, if we were in a higher ATR environment, odds are it would say, yeah, guess what? Scale out of half the position, because you're getting trend mode. And from this move, I mean, it took all this time to go nowhere fast. If we were in a higher ATR environment, odds are this market would have gone right back up, possibly. It would have expanded with more volume, more action, more trading, more keyword here, momentum. In a small ATR environment, there's less momentum in the market, okay? So that's the key. If you're in a small ATR environment, trailing a stop, and that's the age-old question. Everyone says in the age-old world of all the books, trail a stop, let your profits ride. How do you let profits ride in a market that is in a contracting daily range environment? You can't, can you? No. You better be quick to scalp in and out of a market with a contracting ATR environment. And that's why we have that function that you can say, hey, I'm going to just format my model to whatever time you want to trade. I mean, and you can optimize that too. You could say, guess what? Position sizing. Get me into as many trades as possible. I'm going to risk $1,000. I don't want to do 2 lots anymore. Get me into as many trades as possible. I'm going to risk $1,000. Since we're in a small ATR environment, I'm going to change my position sizing model, and I'm going to, instead of using 3, I'm going to use 2, and I want to risk maybe get me into as many trades as possible as, let's say, I don't know, what's on one trade, would you risk $600 on a day trade in crude oil, 60 cents? Get me into as many, let's go $600. Position risk, $600. And let's just fire that off and let's try to see what happens there, right? So in this case, a $600 risk, what did it do? It still got you into 2 contracts. The risk here, it's not going to get you any more. So the risk, you can see where your stop is right there. if I did that right, let me double check. Format strategy. Just make sure I did everything right. I changed our position calculated method to get me into as many contracts as you possibly can with $600 risk. Let's move it to 1,000 and see what happens, right? So if you're risking $1,000 per trade, I mean, some people use that model methodology as well. So you can say, you know what, I like the market so well, get me into it. So basically it's saying on this model and this risk, this is all it's doing. It's getting you into only 2 contracts. So at least you have an opportunity using the algo optimizer if you understand ATR. So understanding the condition of the market you're trading. The first thing I try to teach every trader is, in order to figure out where a market might go, where's the market been? The only thing we can say is, well, it's in an uptrend, it's a downtrend. Okay, great, big deal. What is the condition of that trend? Are we in wide range model mode, or are we in narrow trading range mode? And as I've just shared with you, average true range, you can have a market go up, you can have a market go down, and average true range can be narrow or it could be expanded. And so, except for in the equity market index, where it tends to have wild ATRs on free falls, right? That's when you have expanded ATR environments. That's one that you can rely mostly on knowing that the market is bearish, is by that expansion in ATR in the overall index market, okay? So money management, I mean, max trade loss. If we increased our size, you have max trade loss, $450. Let's change that to $1,000 using our position size 2. And now that we have ability of changing, what is my max risk? I only want to risk so much money. Get me into as many trades as possible, but I'm only going to risk that much. And my max loss, when that happens, get me out of a trade. That's a phenomenal way of having any type of program for any market that you're trading. The functionality of what we've built in the Algo 17 Extreme. So whether or not you want to take a particular trade signal, whether you want to take buys only, long only, short only, everything that we've created in here is designed to make you a better trader and have you execute and have this obviously trade on your behalf of what you see and what you believe based on the facts presented in the back test results. So I hope today the presentation on our PUG meeting was to provide you with better insights on what the dynamics of what constitutes a market and what our expectations should be under certain conditions. And the number one tool to identify the condition of a market would be average true range function. It's not a function of, again, identifying what side of the market to be on. It's a function of your position sizing. It's a function of whether or not you should be getting scaling out of day trades or having a longer, higher time frame holding period to achieve results. Thank you. That concludes our time together today in our PUG meeting. And I hope everyone obviously has enjoyed the Algo Optimizer, the 17 Extreme, with the new versions and the new updates that we've put out. And it's been an incredible year, and I'm glad that all of you are a part of the Person's Planet community. Thank you for joining me tonight. And if our paths don't cross again between now and the holidays, may I say Merry Christmas, Happy Hanukkah to all my friends out there, and a wonderful, prosperous, happy, healthy, keyword healthy, New Year to everyone. This is our last PUG meeting for the decade and our last PUG meeting for 2019. I'll see you guys next year. Thanks for joining me. Ho, ho, ho. Thanks, Don. And George, thank you very much.